Hello and welcome to today's webinar, Convertible Notes, presented by Early Growth Financial Services. My name is Patty Montoya and I'll be your moderator today from the Early Growth Financial Service team. I have a few quick notes before we get started. The webinar will last about an hour and that includes time at the end for questions, so feel free to type your questions into the control panel and we will answer them in between slides. The next thing to note is that this webinar will be recorded and sent to all the registrants with the slide deck within 48 hours. You can also find the recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speakers today, I'd like to tell you a little bit about Early Growth. This is a quote from our founder, David Ehrenberg, and a few of our clients we've worked with before. And here's a quick description of what we do. We're an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. Now, without further ado, I'd like to introduce our panelists, Alaa Ismail and Sirk, who will tell us a bit about themselves and kick off today's discussion. Alaa?
Yes, good afternoon, good morning, or good afternoon to everybody. My name is Alaa Ismail. I'm a consulting CFO here at Early Growth Financial. I've been with them for about 9 years. And I've been helping early stage companies in all kinds of industries, but primarily I handle technology companies since I'm located here in the San Francisco Bay Area. My specialty right now revolves around SaaS services, software companies, but I also do e-commerce. I have a manufacturing company and also some hardware development companies in the mix. It's been a pleasure working at Early Growth, and I like working with companies and watching them grow and to be a great success. Sirk?
And hi everyone. My name is Sirk. I'm also a consulting CFO with Early Growth Financial Services. I've been with the company for a little over 5 years now, so not as long as Alaa, but certainly been here for a little while. And like Alaa, I've also been assisting lots of early stage companies as they develop and grow over time. Like Alaa, I've also worked with SaaS companies, e-commerce companies, hardware companies, even a couple of retail companies as well. And thank you very much all for joining us for this presentation. Hopefully we can be helpful to you as you kind of go through the process of fundraising and getting your company off the ground. Okay, so let's go ahead and get started, and we'll just start with basically what convertible notes are. A lot of people are already familiar with traditional types of financing of companies, and we'll talk a little bit about a funding cycle in a little bit. But just as a brief introduction, convertible notes is basically a short-term debt instrument that a company will use to raise some financing to get a company typically off the ground. Now, there are times when companies will use convertible notes later on in their life cycle, maybe as a bridge between equity rounds of financing, if they're just kind of running out of money and they need to raise some quick financing while they're raising an equity round of financing. But most of the time, you'll see convertible notes used early on, like even prior to the first round of financing. And the reason that we would use convertible notes is that it's, as you can see here, that there is no valuation required, and that's a really key thing, key issue for early stage companies, because a lot of times we just don't have the experience yet. We don't have the traction yet. Maybe we're still in product development mode and we don't have revenue, and we just don't have a lot of basis to form an idea of what a company's worth, and the company and investors maybe have a difficult time coming up with an appropriate valuation that's good for both sides of the company, both sides of the investment. And so convertible note would be a good instrument to use in this case. Initially, because it's a debt instrument, there will be no dilution in terms of ownership. However, obviously, as we'll get into in a little bit, it will ultimately, or it should ultimately turn into equity, and so there will obviously be dilution when that happens. There's no taxes on shares or the debt that you're raising, either to the company or to investors. And the primary thing, as I've already kind of alluded to, is that there's no pricing disputes, and we'll kind of get into the mechanism and why that is the case.
So this is a typical startup funding cycle slide. Now, before I get into it, by all means, different companies and different industries don't exactly follow this flow, but the general premise is as the companies go through this cycle, either while developing a product or getting to revenue, and then there's various cycles within their revenue stream that they will need to raise money. And as the revenue grows and the company becomes a lot more successful, they will raise more money to fund the growth until they get to a situation where the company is either self-sustaining or will have to have some kind of exit event, whether it's an acquisition or an IPO. So that's the general premise of this slide. But again, as a caveat, a lot of companies, for example, enter into revenue right away without any kind of development, without raising any money. There are companies that take a much longer time to develop a revenue stream and might raise 2 or 3 rounds of financing prior to getting to revenue. But that aside, let's just kind of go through a typical growth cycle and funding cycle of a company. This space that we call the Valley of Death is really the early stages of the company. The company is kind of formulating its product plan or its go-to-market plan. They may not have developed a product if they're either a technology company and they're working on it, or if they're a manufacturing company, they still are building it out. So in the very, very early stages, it's very difficult for a company without financing to find funding sources. So that's really where in the early stages, either pre-revenue or in the development cycle, that companies usually prefer to get either angel investments or some kind of seed investment, or and that's really where the convertible debt instrument really falls into place in that first quadrant, the Valley of Death quadrant that's in this slide. As the company develops, they go through various rounds of funding based on either operational milestones or company successes. In traditional terms, these are typically done through preferred rounds of financings. And all the preferred rounds are typically lettered A, B, C, and so on. And then once they're beyond that early stage and they're, say, beyond the C round of stage, there's typically a round prior to an IPO called a mezzanine, which is really the final private round of financing before they go public, getting them ready to go public with all the travails that has, and really setting the stage for an IPO. Mezzanine rounds are not typical. Beyond the C round stage, companies have various exits that are non-IPO. It's really the exception to go IPO right now. Very few companies get there. But they could be acquired by another company. They could merge with another company. So there's all sorts of events that happen later on. But in the typical funding cycle, convertible notes fall in that first quadrant where angel investors or seed investors usually play.
Fantastic. Thanks, Alaa. That's a great description of the funding cycle. Getting back to kind of the convertible note, and now we'll kind of start getting into the description, some of the definitions that are being used, as well as just kind of a general overview of how they work. And really, convertible debt, we start here with saying that it looks like a fish and flies like a bird. As I mentioned before, it is debt. It is technically debt. And so for those of you who understand, some accounting, maybe balance sheet, metrics and things of that nature, it will be placed on your balance sheet as debt as opposed to equity. And that technically it's debt, and so along with it being on the balance sheet as a liability, it will incur interest. So we will be paying interest, or we will be accruing interest on that principal, per the terms of the agreement. There will also be terms like, how long or when should this be paid back, or when will it convert into equity? And so typical terms that you see in a debt instrument, you will see here as well. However, and this is where it kind of flies like a bird, for all intents and purposes, from our perspective, meaning the entrepreneur's perspective, that it basically behaves like a stock, right? That it's really not meant to be repaid. The principal and the interest is really not meant to be repaid. Rather, it's meant to be converted into equity at a later date. And that later date is, we call it the conversion event. And that's basically when, based upon, again, the terms of the agreement, that, upon an event such as an equity round of financing that is priced by an investor, an equity round, so preferred, say, a seed round of financing or a Series A, that the debt, along with all of the accrued interest at that point in time, will convert into equity, based upon the calculations that we'll kind of walk through a little bit later in this presentation.
So what are the features of a convertible note? Typically, and the beauty of it, it's a very short agreement. It's very simple. If you engage any attorney who works in this space, they probably have template agreements. So generating a convertible note agreement takes no time, takes very little legal fees initially to get an initial draft of it. So it's a very short agreement, very easy to understand for both sides. It's simple. These agreements are typically unsecured. And because there's no valuation and there's no pricing, there's just a few terms that need to be negotiated. Because it's a debt agreement, it's flexible, so you could add and deduct any features that both parties agree to. So it's something that can be worked out very, very quickly, and the flexibility is not just in the terms, but it could also mean that you have multiple notes. So for example, you might need $1 million in a convertible note, and halfway, and that $1 million could be done in tranches, or it could be that you take $1 million in the first 6 months, and then you take another $1 million 6 months after some kind of milestone. So these things are very flexible. And the primary reason really is the valuation. There are companies that have very clear valuation that never enter into a convertible note and go right into some kind of equity event, because the valuation is a little bit more clear cut. Very early stage companies, especially companies with no revenue or either no history, it's very, very difficult to ascertain the valuation, yet the funds are needed. So investors like this because they could get into a company that they feel is hot without worrying about valuation, and let somebody else do that later down on the road. And obviously the company likes this as well because it gets them the capital they need to grow. And the terms are fairly standardized, at least here in Silicon Valley. I see many convertible notes, and really the differences are minor in interest rates and discount rates and term and so on. But largely most of these notes are very standardized.
So, did you want to just go ahead and continue?
What are the typical advantages over, say, an equity round or other funding mechanisms? It's short. The agreements are short. They're easy to negotiate. They're easy to draft. So there's not a large process. An equity round could take anywhere between 3 to 6 months to raise in the early stages. These could be done overnight. They're very simple. These agreements are typically 2 or 3 pages, and they're very simple to understand and execute. As mentioned before, they're flexible, so you could have 3 or 4 convertible notes in your growth cycle based on milestones. So they could change very, very quickly. You could terminate a note and change the terms to a new note easily too, if the events warrant. The primary thing here is that there's no valuation, so you don't have to negotiate pricing. Typically, folks who like to invest in convertible notes are angel investors, so they're more interested in your idea or your concept or your business plan, and they are not as worried about valuation at that time. So there's no valuation negotiation. The terms are standard. So again, it's a very, very it's a very easy term to agree to. So those are the primary advantages of a convertible note and why so many companies are going to it. You could create the note very quickly. You don't have to incur a lot of legal fees. The note could change it upon any kind of equity event or any kind of financing. If the parties agree to it, you could tear up the note and do something else. And there's no valuation and the terms are standard. So very, very easy.
Yeah, and thanks, all. And actually, Patty, if we could just stay on this slide for just 1 second, I just wanted to add a couple of things. So Ala mentioned the flexibility, and that's really critical for, not only things like, follow-ons, like Ala was mentioning, maybe you structure it so that, as you hit certain milestones, the investors kick in additional money into the convertible note. Maybe a month or 2 after we close the convertible note, we find some new investors who are also interested in adding on, and so it's just a simple matter of just adding, a note to the original deal and just getting more money in, and of course, they put in money later, and so their interest rate or the amount of interest that they earn will be a little bit less. But in any case, there's a lot of flexibility. The one thing on this slide that I think probably needs a little bit more of a mention on the standard terms, it says here no negotiation, and that's probably a little bit that's probably overstating it a little bit, because there will be a few major terms that ultimately, we do need to negotiate, right? There are some standard amounts that you start with, but ultimately any agreement, as you can imagine, it involves some negotiating, compromises, and making sure that we get what we want and making sure that the investors get what they want. So we'll talk a little bit about the standard terms and what we typically see a little bit later. So Patty, let's go ahead to the next slide.
Yes, we have 2 questions.
Yes.
One is, what are the difference between a convertible note and a SAFE?
Ala, you want to take that one?
Sure. Go ahead. Go ahead, Patty. Did you have something else?
No, I was just going to mention, if you're going to answer this question later on, we can also discuss it later on.
Yeah, we actually will address it in the last slide. Yeah, so we'll address it there. But actually, this is a good break. Let's address it. Convertible notes are debt instruments. SAFE notes are structured in a way that they could be classified as equity. That is probably the primary difference. Also, most of the safe notes that I've seen do not carry any interest, and as such are qualified to be stated as equity on your balance sheet as opposed to debt. They do, however, carry a conversion option and some of the exact same features that we will address with the convertible note. But the primary difference is how it's handled on the balance sheet. Equity.
And there's a couple of other things, like, for example, as it's equity and not debt, technically speaking, it doesn't have to be repaid, like the debt, technically is supposed to be repaid or converted. But as I mentioned before, for all intents and purposes, convertible debt is never going to be repaid anyway, and so that really doesn't have a practical difference, for us as entrepreneurs or the business owners, between the two. I'd say the main things are how it's treated from an accounting perspective, as well as no interest that is accruing on safes versus on convertible debt.
We have another question. What are the tax implications and SEC or state filing requirement, if any?
There are no tax implications. It's just as if you are taking on debt, a loan, basically for all intents and purposes from individuals. And so there are no tax implications, and I don't believe that there are any reporting or registration requirements either for this kind of financing.
That's correct, Sirk. There's no securities exchanging place, so there's no reason to like for the applicable Secretary of State to be involved or any kind of change in your articles of incorporation. So yeah, there's no tax or registration impact.
Perfect. We have other questions, but we can continue and then I can ask them later on.
Okay. Great. And so how does it work? This is very, very simple. You basically determine the amount that we're trying to raise in convertible debt. And so, typically what that means, and you don't just kind of open it up and say, hey, I'll take 10,000 if it's available, and I'll take 100,000 or 500,000 if it's available. Rather, you kind of start with a minimum amount that you really need. And part of it, a lot of it is based upon business requirements, right? It's not just a matter of, hey, I'll take as much as I can get. We really need to be communicating and understanding amongst ourselves really what is required, right? What are we trying to do with this money? What milestones are we trying to achieve? How are we going to bridge from this to an equity round of financing? And typically that requires some planning, understanding of how the cash is going to be used, where we expect to get the milestones that we expect to achieve, and all of those things that really determine the amount of money that we're trying to raise. Once we have that, then basically we work with the investors to present the note terms, and we'll talk again about the major terms that we'll be identifying here. We come to an agreement, we execute the documents, and there's really only two documents here: the note purchase agreement, which both the company and the investor or investors will sign, and then the actual note itself, which the company will sign over to the investor. And once we have that, basically just you exchange those, and obviously the attorneys are involved in making sure that all the paperwork is done properly. And once all that is done, then basically we receive the check or the wire from the investors, and the investor gets the note agreement. And that's pretty much it. It says, update the cap table to reflect the new debt. But really, it's only almost a footnote, because obviously the cap table itself really looks at the equity portion of the balance sheet, and there's no new equity. But it's really just a matter of us understanding how much debt is on the books, how much are we going to be accruing interest, what's our ultimate liability, or what's the ultimate amount that's going to convert into equity when the time comes, and that's what. And so it's again kind of points to just how simple it is, as opposed to For those of you who've actually been through the trials and tribulations of trying to raise an equity round of financing, the level of effort that is required, the level of dotting of I's and crossing of T's, the filings, the legal work and all of that. This is a very, very simple, as Alaa mentioned, it could literally be done. The paperwork can be done, overnight or over 1 or 2 days, as opposed to taking months and months and months.
That's right. The only the one thing I would add to this, to the cap table, it's not something, of course, that will be in the details of the cap table because there is no shares being exchanged. However, I've seen in the, like Sirk mentioned, a footnote typically in a cap table that, or a separate tab in a cap table that kind of breaks out the convertible note or the convertible notes and the related terms. There are instances where companies have not just one convertible note, but they might have 10 or 15 with various terms on it, and they like to put that in the cap table so any kind of prospective investor will understand the full scope of the capitalization of the company on a pro forma basis.
We have a couple of other questions. One is, what is the seniority of a convertible note relative to other investments, other notes or equity?
Would you like me to take that, Sir?
Sure.
Okay. So to the extent that you have other debt on your balance sheet, typically there's a the more senior debt is anything that's secured. For example, if you have an accounts receivable line of credit, and that's secured by your accounts receivable or any other assets, that would take priority over a convertible note. Remember that a convertible note is not secured. Typically, it's not secured. So there is no security arrangement. So therefore, it's junior. If you have, for example, a bank line of credit, typically that will take precedence over a convertible note. A convertible note is really not meant to restrict your access to capital, but to help your access to capital. So typically the terms would allow for you to get certain other debt. However, as a convertible note holder, you do not want the company to just go off and dilute or get so indebted that your investment becomes troubled. So there may be some terms in there that would kind of restrict you from the amount of debt that you could carry. But from a seniority point of view, typically other secured debt would have a more senior position than your convertible note.
And then I think just to add to that, I think Patty also asked about, how is it in relation to other investment and equity? All liability is senior to equity. So basically, if there is, after everything else is paid off, if we liquidate the company and there's some funds left over, the convertible note holders will get the money before any equity shareholders.
Yeah, I have some other questions, if you don't mind.
Yeah, go ahead.
So, if you have multiple convertible notes, do they all have to have the same terms?
No. They can be, each can be, and I've seen this happen where, you start with a convertible note and you raise, several $100,000. You think that that's going to get us to where we need to go, but ultimately, when we start, getting low on funds, we decide as a company that we should just go ahead and increase the amount of convertible notes, and that can absolutely be negotiated separately. It could just be, typically what we usually see is companies that say, hey, we've already got a convertible note on the record, let's just go ahead and continue this or add on to this with a new investment. But it's very, very possible that the new investors will come in and say, hey, you know what, since that's happened, the dynamics have changed, right? Maybe I need there's a little bit more risk, or maybe interest rates have gone up since we did this last, and so instead of 5%, I should be getting 6%. And so yeah, you can get into a situation where you're negotiating new and different terms than the previous round of convertible debt. So yeah, it absolutely can happen. As I mentioned earlier, basically every one of these is ultimately a separate transaction, right? So we can start with kind of what's already on the plate, but ultimately it's up to the company and to investors to determine what's right for both sides.
Perfect. I'm gonna continue. Let's continue, and then I'll leave the questions at the end to see if we have time for all of them. Okay.
Great.
Okay, so what are the terms that we've just been discussing? Obviously, the interest rate is a typical term that's negotiated. The interest rate term, again, because if you work with a standard, one of the lawyers that is familiar with it, you will probably go into this negotiation with a range of interest rate based on what's happening in the marketplace. And that's really will be your starting point of negotiation. To the extent that you are, more in need, there's not a lot of people offering to lend you money. You're maybe risky, your interest rate might be a little higher. And that will be something that you will have to negotiate. And again, supply and demand principles apply here. You have a lot of folks that are willing to advance you money. You might be a little bit more rigid in your negotiation, but if it's your sole funding, you might not have as much leverage. The term, part of it, this is a pretty critical thing of the note. I've seen terms as short as 3 months where the convertible note is a bridging instrument to get from one round to another, to a term of a couple of years, 24 to 36 months. I've also seen note terms that are essentially 12-month, and then they have a rollover provision, and that is primarily done to basically track the progress of the company. It helps both the investor and the company because it allows you to reset terms based on where you are. If you're doing very, very well and things look like you're going to get to an equity round fairly soon, you might want to, after a year, want to renegotiate the interest rate, for example, and vice versa. If things aren't going very well, maybe the investor would want to renegotiate the terms to be a little bit more to his advantage, and increase the terms of the interest rates and so on. The discount. All these notes typically have a discount rate, meaning at the conversion, what will be the applicable income, conversion. So typically the discount rate applies to whatever the negotiated price. So for example, you have a convertible note, and now you're going to either a seed round or an A round. And the negotiated price based on the valuation is $1 a share. And if your negotiated term in your convertible note or discount is, say, 20%, you will get a 20% discount off of that $1 per share. So your converted dollars, your principal plus accrued interest, will convert at the discounted price. So that's something that you really need to negotiate, because too big of a discount might discourage potential investors, and too little of a discount might discourage your convertible note investor. So that's something that will be negotiated. Going back to a caveat here, an attorney who is experienced with these will help in this process greatly, and will give you guidance on the discount rates and related negotiations. The note cap, we mentioned before that sometimes these notes are done in tranches, or sometimes you might want to come back and renegotiate the terms. So You don't want the term to be open-ended or the note to have open-ended provisions. So typically there's a cap to the amount that that can be financed or the principal amount that can be advanced. So that you'd want to negotiate as well, because you want to give yourself a little bit of flexibility. So you don't want to be too rigid in that negotiation. And finally, the financing amount. You know, do you need a large sum at once, or can you tranche it out over several payments? And of course, that will be the primary bit of negotiation. And as you can see in a lot of these terms, it's not a slam dunk where you're going to somebody who's willing to invest in you to just say, hey, I need $1 million, here's a note, sign it, and let's get going. You do have to do a little bit of homework, because you don't want to get into a convertible note where that is your sole financing instrument. You want to be able to plan it out with the goal of getting into an equity event. So figuring out how much you need will depend on that. What is the time that you feel that you could go out there and raise a round of funding? And based on that, if it's a year, what does that year look like? Is it $1 million? Is it $2 million? Or is it a couple of $100,000? So these are the typical terms that you'll be negotiating and are incorporated in a convertible note.
And actually, let me just add one thing before we get into the nitty-gritty of each of these, which we will. But also on the note cap, so there's two parts to it. There is one, obviously, the amount of money that can be raised in the convertible note, but it's also used as a calculation of how much the convertible note holders are ultimately going to get during the conversion to equity. So we'll use, and we'll talk about this, but we use both the discount as well as the note cap to determine how the convertible note is converted into equity, and we'll get into the details of that in just a bit here. So let's go ahead to the interest rate, Patty. So the interest rate is obviously a simple one that we all kind of know you know, as we deal with, you know, auto rates and mortgages and other types of debt that we take. So basically, since it is a debt instrument, we are going to be incurring interest charges, meaning that the note holder will get, you know, reimbursed or get paid for the time of the amount that we're taking the money on, and so, you know, what is that interest rate? Again, you kind of, you know, determine what the macroeconomic situation is, as well as our individual negotiating position. But, you know, typically you'll use something that is tied to, you know, like an accepted standard, like a LIBOR or Fed funds or you know, any kind of rate like that. You know, right now we're seeing a lot, you know, because of the relatively low interest rate environment that we're seeing. So we're seeing, you know, relatively low numbers. I've seen as low as 4% interest, as high as 8% recently. So somewhere in that range is kind of what you can expect. And so, you know, that's part of the negotiation. You won't be paying this out in cash, though. Again, the interest will accrue over time, and then during the conversion from convertible debt into equity, all of that accrued interest will get added on to the principal amount, and all of that will convert into equity. And so, you know, there's no cash involved in terms of actually making payments on interest. And you know, but however, from an accounting perspective, and now, you know, obviously, you know, us accountant types are keen on this kind of stuff. On a monthly basis, we want to be accruing that interest as an expense, you know, because it is a true expense that we ultimately have to pay in equity. And so, you know, you just, you know, per what Alaa was mentioning before, we've got a cap table that will identify all those amounts of convertible debt over multiple tranches. They'll have the date of the agreement that's signed. And so on a monthly basis, we'll just kind of take that interest amount and we'll expense that and we'll add that to an accrued liability account on the balance sheet.
Okay. So the next item on the note that is the term. What is the maturity date? Essentially, it's if no triggering events, and primarily the triggering event will be an equity raise. So if no triggering event occurs, when will this note mature? So that will essentially be the date that you will either have to renegotiate or you'll have to repay the principal and accrued interest. There's always a term on these notes. So even though the primary understanding is that it will convert, you have, like all notes, you have to have a triggering or a term on the note. And typically the note will have some kind of conversion threshold. So the typical term is usually 24 to 36 months. Like I said before, the conversion terms have been as short as 3 months. But usually these notes are right around 2 to 3 years, and dependent really on your comfort level on when you think you're going to go out there and raise a round of financing based on your operational plans. So when the note matures, you really have an option. You could either convert it if there is a equity event that occurred, or you could repay it. Perhaps you don't need to go out to the marketplace and raise more round because your enterprise is doing well and you want to bootstrap it and not go out to the equity market to raise more money. So just you could repay the note and the accrued interest and not convert. Or if there's a way to convert it, I've actually seen an instance where there wasn't really a preferred round, but there was an agreement between the parties that this was essentially a methodology to convert it into common stock. It's very rare, and it's outside the term of the agreement, but I have seen it done. And if you're either not converting or not repaying, and this is actually what I've seen more times than not, there's a renegotiation process. So you basically will go back and say, well, we haven't been able to raise a round because of these factors, or we think we need another year or another 6 months. And again, because this is not secured debt, usually the investor is very amenable to renegotiation. There's really not a lot of leverage that they may have at the time. So more often than not, upon the termination of the note or the term of the note, if there is no conversion or repayment event, then the terms are usually renegotiated or extended.
Yeah, that's right, and we see that really we see that it's very, very typical, where a company starts with a 12-month maturity, for example, and then as we get into 10, 11 months, we recognize that we haven't closed an equity round of financing, and that we really don't have a mechanism to convert that equity at that point in time, and we certainly and we don't have the money to actually repay it. Then it's very, very typical for us to go back and do a one-page agreement that extends the maturity date out another 6 months or 3 months or however long is appropriate. And so that's it's not uncommon at all. Okay, the discount, this is really, really simple. I think the convertible note cap is actually more involved. So really, if you think about it, as Alaa already mentioned before, since the note holder is financing the company at an early stage, there's obviously a little bit more risk. The earlier you invest, there's more risk. There's also more risk associated with not knowing what the valuation is. And so for those reasons, typically there is a discount. 20% is standard. And so as Alaa mentioned in his example, if the equity round of financing is being done at $1 a share, then the note holders, both the principal and the interest accrued, will actually get to purchase the shares at 80 cents a share instead of $1 a share. And so that's one of the advantages and one of the perks of investing in a convertible round of financing for investors. And obviously we know what our benefit is. We get the money earlier without a lot of negotiation. This recent trend in Silicon Valley towards lower discounts, I think it just kind of depends, right? It depends on the state of the company, how much demand there is, how easy is it for us to raise a convertible note. Is this a true convertible note at an early seed, or is this more of a bridge between one equity round of financing and another, and we're just kind of buying ourselves 3 to 6 months? All those things will factor into what the actual discount rate is appropriate for the deals.
Okay, so this is really another term, and it's probably the more critical term on the convertible note that will have to be negotiated. Again, this is something that that you will work with your lawyer to set the note cap. But typically a note cap, it sets the maximum valuation that the stock can be converted into equity, or the amount of your note can be converted into equity. And the reason why this is done is that it will then align the incentive of both you and the investor, so not to basically take advantage of either side. From the founder's side, you want to set the maximum note cap at a reasonable level, so the note doesn't become over dilutive, or discourage some of the potential new investors that you want. So you want that note to have some kind of a cap to give you incentive to go out there and raise an equity round sooner than later. And then also from the investor side, you want a reasonable note cap as well, because the intention of your investment the intention of your advancing the money is not really as a debt instrument, but as an investment. So, creating that note cap or negotiating that note cap kind of aligns both the investor or the funder with the founders or the company. The investor or the person that's advancing the money, they either convert at the lower of either the pre-money valuation of your next qualified round or this cap. So essentially, that's what the note cap does. So it sets kind of a boundary of where your conversion will happen. And so, so you'll either convert either using whatever this note cap is, or with the discount, or you could use it at whatever the pre-money valuation plus with your related discount that we'll cover later on in Sirk's presentation. But it's typically not. Both of these are not used in conversion. It's either one or the other, the note cap or the pre-money valuation that you negotiate in whatever your next equity raise is.
Yeah, and we'll look at a couple of examples, and really ultimately what it is that that it'll become very, very clear which of the two, whether you use a convertible note cap or the discount, to determine how much the convertible note holders are going to be paying. It's kind of up to the note investor to pick the one that is most beneficial to them. And so to that point, I'll just kind of, at a high level, I'll just say that from a founder perspective, from a company perspective, having no note cap having the valuation of the company kind of float to whatever the valuation should be, and the note holders get whatever whatever they get based upon the discount rate is the most preferable, right? We give up the least amount of equity if we do it that way. However, we also have to, as Alaa mentioned, we have to look at it from the perspective of incenting the note holders to make the investment in us. And if you think about it from their perspective, they're putting in money early on. They are not getting any guarantees as to how much equity they're going to get for this convertible debt that they're putting in. That's going to be determined later. Well, let's say that, let's say they put in $1 million in a note cap, or I'm sorry, in convertible note, and they kind of have this expectation, hey, I think this $1 million is going to get me, 10% of the company, when the round of financing happens. But let's say that we really blow it out of the park, and instead the company's worth at the next round of financing, instead of 10 million, which obviously the $1 million would become 10%. Let's say it's worth 50 million. Right now, that without a note cap, the investor that put in the $1 million in convertible note only is getting 2% of the company, and so obviously he or she is going to feel a little bit taken advantage of in that case, and so this is more of a protection for the investor to make sure that there is a floor as to the amount of equity that they're going to be earning during the conversion. Yeah, so yeah. and so these are just some of the things that we just kind of want to be looking out for. You just want to make sure that we don't get caught with a short maturity date, although as I mentioned, we can probably fix that later. Obviously an excessive discount rate, gives the investor a lot more equity than we'd like to give, and so we want to, we as an entrepreneur, as the equity shareholders in the company, want to limit that, and then these other things like restrictive covenants and not paying or not converting the convertible notes is what we want to watch out for. Okay, we're going to just go really quickly here. I recognize that we're 10 minutes away from the top of the hour. So there's a couple of examples here that use both the that use some hypothetical numbers and look at kind of what happens and how we convert from convertible debt into equity. And so let's look at this first one. And sorry for the eye chart here, but if you take a look at the left side, you'll kind of see what the company pre-funding looks like. So there's 8.5 million shares of outstanding common stock that's owned by the entrepreneurs as well as the employees and other shareholders of the company. There's a note size of $575,000. There's a note cap of 4.5 million. So we'll kind of talk about that again. And then there's a note discount of 20%. Okay, so those are kind of the terms that we negotiated initially during the actual funding of the convertible note. And under the Series A terms, so here it says that we're actually raising an additional $1.5 million in Series A investment, and we're doing that on a $4.5 million valuation. And you can see that $4.5 million is identical to the note cap. In this scenario, if you take a look at the next two sets of columns, both under the discount and the cap, it actually calculates what happens to both the Series A investors as well as the note holders at this conversion. And in this case, you can see that if you take a look at the note holder at conversion, that the share price between the two, you can see at the discount that they will actually get a 20% discount from the 44 cents per share of Series A. They'll pay 36 cents a share. They'll get 1.6 million shares of equity, and they'll own 12% of the company. If we did the same calculation using the cap at 4.5 million instead of the 20% valuation, you'll see that they'll pay the same exact share price as the Series A investors at 46 cents a share. They'll only get 1.2 million shares, and they'll only own 9.58%. And so in this example, it's very, very clear that the note holder will choose the discount and they'll obviously pay 36 cents a share instead of 46 cents a share, and they'll own more of the equity post the conversion. And then real quickly, let's go to the second example, and this is kind of where the note cap really comes into play. And so in this example, start with the same exact numbers, 8.5 million shares of outstanding, common stock, $575,000 of note, note cap of 4.5 million, and a 20% discount. But in this case, basically, compared to the last one, we've really done a great job with the money, and we are able to negotiate terms with Series A investors such that we're worth a lot more than in the first example. We're worth $13.5 million instead of $4.5 million. Well, again, if we kind of look at the discount versus the cap, at that valuation, obviously the share price is much greater. So for this same number of shares, both the Series A investor as well as the note holders are going to be paying a lot more. But in this case, you can see that if we actually took the $1.50 a share that the Series A investors are going to be paying, and we take a 20% discount, we, meaning the note holders, would be paying $1.20 a share. They would only get $478,000 shares. They'll own 4.79% of the company. And then obviously compared to the cap, now here's that cap. Here's where it comes into play, right? So we're assuming that we're going to be investing, or we're going to be converting at that cap of $4.5 million valuation. And so, per the previous example, you saw that the share price at that valuation was 46 cents a share. So in this case, the note holder gets to convert as if the company was only worth $4.5 million, and so they still get to purchase the shares at 46 cents a share. And you can see the huge difference in terms of the number of shares that the note holder owns, as well as the percentage of the company that they own after conversion. And so these are two obviously very extreme examples of what it would look like, and why from a founder's perspective, we want to be very careful about the kind of way that we would negotiate both the discount as well as the cap. Clearly you don't want to piss off convertible shareholders by placing the cap at such a high valuation or no cap, because obviously that puts undue risk on the note holder. But at the same time, we don't want to put the cap at such a low rate that the investors can see a huge increase in their equity just because of the fact that we were somewhat successful using the money to improve our prospects.
So what Sirk mentioned is important. However, the one thing that I'd like to kind of give a little background, a lot of this is kind of automatic at the time of conversion. Typically, your prospective investor at the time of the raise will have an understanding of what your convertible debt positions are. So that will be kind of baked into the negotiations of the pre-money valuation and all the valuation discussions that you have with your prospective investor. So that will all be done, and then once that kind of negotiation is done, and you've done a good job in negotiating creating your convertible note, this kind of discussion of which way to go will be kind of automatic based on what you've already negotiated with your next round investor. And also remember, your convertible note holder is there basically to get to this event. So they're also going to be very keen on getting there and having their debt now convert to equity, because now there's a placeholder out there, or there's a market evaluation event that occurred. So now he or she has a stake in the company. So while this is a useful exercise to see how it will work, when the time comes, a lot of this is kind of automatic.
Good point, Alaa.
Okay, so the downsides of convertible notes, or any kind of it is debt, and the people that are going to be investing really are not wanting to be a debt holder. They want to get to an equity. So that is a minor downside. This debt will incur interest. So to the extent that you know that you hold it out there, then whatever that note, the principal portion of the note will incur more interest as time goes by. So it is kind of a floating amount. So the more time that passes before your equity event, the more value then that debt instrument will have. Again, while that is kind of an incentive for folks to enter into these convertible debt instruments, they really don't care. They want to get to a equity round as quickly as possible. So the debt has to be repaid, but then what happens if you can't? So you know, at some point you'll hopefully never get into this discussion, but at some point you may have to have that discussion with your equity, with your convertible note holder. So here's when we get back to that original question of safe notes. So why are safe notes created? It essentially avoids really the minor downsides of convertible notes, in that it's essentially equity. It doesn't accrue interest. It's stated on your balance sheet as equity, and it kind of acts more like a stock than it does debt. So if you ever get into this dilemma of you don't have funds to repay, the pressure with a safe note is a lot less than a convertible note. So really, as you could see, the downsides or alternatives to a convertible note are very, very few. A safe note is probably an alternative, and however, the vehicles to get there, if you're going from a convertible to a safe, is a little bit more difficult. And typically, safe notes are in lieu or replace a convertible note and are done very early on. So the primary advantage of a safe note is it doesn't have a repayment term and doesn't accrue any interest. So really, those are the downsides of convertible notes.
Perfect. I think we're past. I'm gonna ask 2 or 3 questions, and then the rest of the questions we can answer over email. So, what is the responsibility of a company to tell holders of convertible debt when they sell to transfer the company to someone else?
Okay. So I guess it kind of depends on how that transaction or how that sale typically happens. Typically, if there is a convertible note on the books as a liability, then that will just be paid, right? So if the convertible note actually hasn't converted it into equity, and we sell the company, then obviously, we'll take the proceeds of the company or of the sale. And we will distribute the amounts that are due to the convertible note holders, including the principal as well as any accrued interest, prior to any of the remaining amounts being left for the common shareholders.
Perfect. Do we issue convertible notes to accredited investors only?
Actually, no. Anybody could be a holder of a convertible note. It could be, Uncle Bill, or it could be a non-accredited investor. Remember, you're not entering into an equity transaction. So all the related rules for accredited investors do not apply here. This is in the same way that anybody could lend you money, and the same applies to convertible notes.
And then the last one, does a convertible note get repaid before a safe?
You wouldn't use both. You'd use kind of one or the other. So I've actually never seen a situation where a company starts with a convertible note and then follows that up with a safe. So I kind of have to think about it, but I don't think that's the way it would work, right? Because safe is kind of the same thing, similar thing in terms of what it's trying to do, which is to give the company some money prior to any kind of pricing of an equity round of financing. So both safe and convertible notes are meant to convert into equity at the first price round of financing. And so I can't imagine a situation where a new deal would happen after a convertible note is already on the books, where new investors would come in, or even current investors would come in and put in money into a safe and expect to have the convertible note holders be paid off.
Yeah, Sirk, that's spot on. Remember that essentially a safe note and a convertible note are all they're agreements. So the difference between a safe note is really the form, and a convertible note is the form of the agreement. So say, for example, you have a convertible note and it matures, or you want to get to a situation where you want to change it to a safe note. You could basically go to whoever is holding your convertible note and then either terminate the existing note or and then create a new safe note, and then all of a sudden the terms change. But like Sirk, I have not ever seen a situation where a company has a safe note and a convertible note. So I'd have to look into that.
Perfect. I think we're going to close here. I know a lot of you have questions, but I want to be aware of everyone's time. I'm going to send out this presentation and the webinar recording. If you have any questions, Alaa and Sirk will be on the email, so you can email them directly and they can help you with any questions you might have. Thank you very much, Alaa and Sirk, and we'll let you know of the next webinar.
Thank you, everyone.
Thank you.
Bye.